on an analysis of Cemtrex, or CETX, right after that huge 36% one-day crash. It's weighing, is this a dip buy or just a classic value trap?
And what really jumps out, and I think the report does a great job with this, is immediately framing it around that insane valuation disconnect.
Yeah, that price-to-sales ratio of 0.05, it's the perfect hook. It tells you immediately why you should even care about the stock.
It really does. But it also raises a huge question that I'm not sure is fully answered. I mean, while the report powerfully highlights this disconnect, the core argument could be so much stronger if it dug deeper into why the market just ignores $67 million in revenue.
Right. We see the explanations given the net loss, around $7 million, and of course, dilution risk.
Yeah.
Lone fact. The weakness, I think, is that it overlooks the need to really quantify the quality of that revenue. The market often discounts huge revenue numbers for a reason.
Precisely. For a microcap that's structurally challenged, high revenue can be a total vanity metric. We have to get past that simple PS number.
So what's beneath the surface?
Well, what about debt? What about their cash position? I think the analysis really needs to integrate a more robust financial view that goes beyond gross revenue and looks at the company's total liability structure.
Okay, so you're suggesting a way to clarify for the listener what that $66 million in sales actually means for the company's immediate financial health.
Or lack thereof, exactly.
So, practically speaking, you're saying introduce something like the enterprise value to sales ratio, the EVS?
Yes.
PS is so simple, so effective at screaming cheap. Why is EVS the more critical metric here, especially since we know they're burning cash?
Well, PS is easy, but it can be really misleading for a company like this. It only looks at the market cap, basically the price of the stock.
Right.
EVS, on the other hand, it brings in the market cap, yes, but also the debt, and it subtracts the cash. So if the company is loaded with debt,
which a lot of these turnarounds are,
an acquirer isn't just paying that tiny market cap, they're paying the enterprise value. They're inheriting all that debt. That's the true cost of buying the whole operation.
That's a huge distinction. It completely reframes the narrative. It moves the analysis from insane bargain to potentially risky acquisition that comes with a very big tab.
It does. And to build on that, we also have to question the revenue itself. The analysis should really dig into that $67 million figure. Is it project-based? Is it cyclical?
Or non-recurring, which would be a huge red flag.
Exactly. If that revenue stream is volatile, the analysis has to say explicitly that the market values that kind of revenue way lower than steady recurring sales.
Which reinforces the market skepticism.
Yeah. If that revenue gets cut in half next quarter, that PS metric looks totally different, and the analysis needs to account for that risk.
I agree. Without quantifying the quality of the sales, we're really only seeing half the story. We need to move from just observing the disconnect to explaining the cause of the market's discount.
Perfect. That sharpens the whole thing up.
Okay, so moving on from the balance sheet, let's pivot to the bear case. I'm looking at the section on the reverse split history. The report uses that 1-for-15 split as evidence of eroding confidence. But is that history really the central fear?
That is the exact question. And I think the analysis should take a much stronger stance here. It should elevate the company's documented history of reverse splits from just being a contributing factor
to being the foundational evidence driving the market's primary fear.
Which is dilution. Absolutely.
I can see the weakness right now. It lists the reverse split next to cash burn and dilution risk, almost as if they're, co-equal problems.
But they're not. For microcap investors, and that's who this report is for, a reverse split isn't just some isolated event. It's a pattern. It's a signal that the company will sacrifice long-term shareholder value just to stay on the NASDAQ.
And that creates this deep-seated expectation of future dilution.
Right. That link, that crucial link between past actions and present fear, it's just understated right now. The problem isn't just dilution risk exists. The problem is a total lack of trust that stems from a history that makes future dilution seem inevitable.
So the suggestion is to restructure the entire bear case. Position that erosion of shareholder confidence from the split history as the central structural reason the market is pricing in more dilution so aggressively.
Exactly. It makes the argument much more about cause and effect. It's not just there's a risk of dilution. It's the company has a predictable track record that creates the fear of dilution.
So a concrete example would be, instead of having reverse split history as its own bullet point,
you integrate it directly into the dilution risk section. The report should state clearly that this history is the reason why dilution is the #1 fear driving the stock down. It connects the dots.
And we could make it even sharper by contrasting the optimism with the reality.
How do you mean?
Well, the report mentions a 150% analyst upside target. We could suggest adding a sentence that puts that right next to the fact that the stock is down, 93% over the last year?
Mm-hmm.
Despite previous corporate actions that were supposed to create stability, that just hammers home the risk factor.
Okay, I like that. Now, building on that point of extreme risk, because the report labels this an extreme 10-10 trade.
Which it is.
We have to look at the technical strategy. If you're asking someone to make a trade this risky, you need to give them an incredibly sharp plan for getting in and, more importantly, getting out.
And I think while the technicals correctly spot the oversold conditions, the strategy itself could be way more robust by directly linking the entry and exit points to those fundamental risks we've been talking about.
I see the weakness here immediately. It's relying on these generic indicators, right? RSI below 30, watch for a high-volume green candle.
For an extreme risk trade on a stock with a tiny float, it's too vague. That situation can change in minutes.
Right. The suggestion to just watch for a reversal doesn't work here. This stock could jump 50% or drop another 30% on a press release. The technicals need to translate that fundamental fear, the whole value trap idea, into actual price levels on a chart.
So the fix is to sharpen the strategy. Use the psychological support levels and those analyst targets to define a really clear risk-reward profile, one that's tied directly to the two outcomes. This is either a huge opportunity or it's a trap.
We need boundaries, actionable boundaries. The weakness is the generic indicators. The fix is setting hard limits. So instead of just saying support is somewhere in the $2.50 to $4 range,
You have to be more explicit.
yes, propose a concrete stop-loss strategy. That's essential for a 10-10 risk trade. For example, advise that if the price breaks below, say, $3.50 on high volume, that specific signal confirms the value trap scenario.
And that justifies an immediate exit, no questions asked.
No negotiation. It gives the analysis a clear, measurable failure condition that's derived right from the chart.
Useful, it's defining failure, which is arguably more important than defining success with a microcap.
And you can do the same for the upside.
Quantify the reward. Use that $11 analyst target as a potential ceiling.
Exactly. Use it to frame the entry. So now that high-volume green candle isn't just a vague signal. It's an entry point within a very specific, calculated risk-to-reward ratio. You know exactly what you're risking to potentially get to that high-level target.
So the key is shifting from just spotting oversold conditions to actually mapping the fundamental scenarios onto the chart. If dilution is the big risk, the technical failure point needs to confirm that the market is finally capitulating to that risk.
That sharpens the tactical advice immensely.
So looking back at all 3 points, there's a clear theme here. It's about taking the really good data and that high-stakes framing the report already has and just deepening the context, explaining the why.
Yeah, moving from just observing the crash to offering a structural explanation for the market's behavior.